We have officially entered the event horizon. For years, we have warned that the silver market was broken. We warned that the suppression was artificial. We warned that when the dam finally broke, the water wouldn't just flow, it would crash. Today, Saturday, December 27th, the dam didn't just crack, it disintegrated. Look at the closing data from the electronic session. The price of silver is trading at $79.25. That is up $7.34 in a single trading day. That is a move of 10.21%. Let me be crystal clear. Commodities do not move 10% in a day during normal market conditions. A 10% move is not a rally. It is a liquidation event. It is a crime scene. What we just witnessed was the death of a major financial entity. Somewhere in the world, a massive short seller just blew up. They were forced to buy back every single contract they held at market price. They didn't care about the cost. They didn't care about the chart. Or they hit the buy button until their account balance hit zero. And because this happened during Ghost Week, the thinnest liquidity week of the year, there was nobody there to sell to them. The price teleported. It went vertical. We are now standing on the doorstep of $80. In this emergency market update, we are going to dissect the anatomy of a melt-up. We are going to look at the $4,534 price of gold and why it proves that the dollar is collapsing in real time. And we are going to prepare you for Monday morning. Because if silver closes the week at $79, the Sunday Open will likely trigger a limit-up halt that freezes the entire global exchange. The game has changed. The system is broken. And the panic is just getting started. To understand the violence of a 10% move, you have to understand the mechanics of forced buying. In a normal market, buyers and sellers negotiate. I want to buy at $75. You want to sell at $76. We meet in the middle. But in a liquidation, the negotiation stops. The clearinghouse takes over the computer of the bankrupt fund. The algorithm has one instruction. Close all positions immediately. It doesn't care if the price is 75 or 79 or 100. It just buys. It consumes the entire order book. This morning, we saw a vertical line on the chart. That line represents the market impact of a whale dying. The volume was massive. The speed was instant. This confirms that the short squeeze has moved from a theoretical risk to a systemic reality. The dominoes are falling. First, it was the retail shorts, then the family offices, now the institutional funds. Next, it will be the bullion banks themselves. When you see a 10% move in silver, you are seeing the repricing of the global monetary system. This isn't just about supply and demand for a metal. This is about the loss of faith in the currency used to price that metal. Investors are looking at the US dollar and they are saying, get me out. Get me out at any price. Now, let's look at the context. Gold. Gold is the big brother. It usually leads. Gold is trading at $4,534. It is up over 1% on the day. This is a historic breakout. $4,500 is a number that economists said was impossible. They said it was a doomsday number. Well, doomsday is here. The fact that gold is holding $4,500 validates the move in silver. If gold is $4,500 and the historic ratio is roughly 15 to 1, then silver should be trading at $300. At $79, silver is still mathematically cheap. It is lagging. It is trying to catch up. This catch-up trade is powerful. Algorithms look at gold. They see it at all-time highs. Then they look at silver. They see it is still 50% below its inflation-adjusted high, and they buy. They buy billions of dollars worth of silver because it is the only asset left that hasn't fully repriced to the new inflationary reality. So do not be afraid of the vertical chart. It looks scary because we are not used to it. We are used to suppression. We are used to slow, grinding moves. But freedom is messy. And right now, the silver price is breaking free. We need to talk about the weekend risk. It is Saturday. The markets are closed. The price is locked at $79.25. But the news cycle is spinning. Headlines are starting to break about bank insolvencies and hedge fund failures. Rumors are swirling about a settlement failure in London. This creates a psychological pressure cooker for everyone who is not holding physical metal. If you are holding paper, you are terrified. You are wondering if the exchange will even open on Sunday. You are wondering if your broker will be solvent on Monday. This fear drives capital out of the system and into the physical market. We are seeing reports that online bullion dealers have completely pulled their inventory. Site maintenance, sold out, call for pricing. These are the signs of a physical market failure. They cannot price the metal because the metal is moving faster than their software. If you try to buy a coin today, you might pay $100. The spot price of $79 is already irrelevant. The street price has crossed the triple-digit barrier. This disconnect between the frozen screen and the desperate street is the definition of a currency crisis. When you cannot buy goods for the official price, the currency has failed. We are living through a historical pivot point. The world is realizing that paper promises are worthless when the vault is empty. Let's analyze the limit up scenario for Sunday night. The CME group has rules. They are called circuit breakers. If the price of silver rises by a certain dollar amount in a single session, the exchange halts trading. They freeze the market. You cannot buy, you cannot sell. The screen just stops. With silver closing at 79.25, if we gap up on Sunday night, we will hit the limit up threshold almost immediately. What happens then? Panic. Pure, unadulterated panic. Imagine being a short seller. You're losing millions. You want to buy to cover your loss. But the computer says, market halted. You're trapped in a burning building and the doors are locked. You have to wait for the market to reopen. And when it reopens, it gaps up again. This is how you get a locked limit up market. It can stay frozen for days. We saw this in the nickel market in 2022. We saw it in the lumber market. Now it is coming for silver. If you see the market halted on Sunday night, do not be alarmed. Do not call your broker screaming. It means you have won. It means the demand is so overwhelming that the machinery of the exchange cannot handle it. It is the ultimate validation of the thesis. But you must be prepared for the volatility that follows. When the limits are expanded and the market unlocks, the price discovery will be violent. We could see silver trade in a $10 range in a single hour. This is not a market for leverage. This is a market for ownership. Let's look at the January effect again. We talked about this before, but now the context has changed. The funds that were planning to buy in January, they are looking at 79.25 and they are panicking. They realize they waited too long. We missed the $70 entry. We missed the $75 entry. Now they have a choice. Do they chase it at $80 or do they wait? History tells us they will chase. Institutional investors are momentum chasers. They buy high to sell higher. The fact that silver is up 10% in a day makes it more attractive to them, not less. It signals alpha. It signals performance. So on January 2nd, we are going to see a wall of money hitting a market that is already broken. This 10% move is just the pre-shock. The earthquake happens when the pension funds arrive. We are setting up for a move that could take us to $100 by mid-January. But we have to be realistic. Nothing goes up in a straight line forever without a check. A 10% daily candle is usually followed by extreme turbulence. We might see a profit-taking flush. Traders who bought at $65 are sitting on massive gains. They might sell to lock it in. We could see a sharp drop back to $75. This would be normal. It would be healthy. Do not let a pullback shake you out. In a vertical market, a $5 drop is just a dip. It is a buying opportunity for the whales who missed the breakout. The trend is up. The supply is gone. The banks are broken. Any dip is a gift. Now, let's talk about the black swan potential. When a market moves 10% in a day without a specific news headline, it usually means the news is coming. The market sniffs it out first. Someone knows something. Is it a bank failure? Is it a geopolitical escalation? Is it a new export ban from China? We don't know yet, but the price tells us it is bad. Information asymmetry. The insiders are buying because they know what is about to hit the tape. By the time you read the headline on Monday, the price will be $85. This is why you buy the price action, not the news. The price action is the truth. The news is the excuse. So what should you do this weekend? Your job is to stay calm. You are watching history. You are watching the collapse of a 40-year manipulation scheme. It is messy. It is loud. But you are on the right side of the trade. Check your security. Check your storage. If you have silver in an unallocated account, get it out. If you have silver in an ETF, read the prospectus. This weekend is the time to audit your holdings. Because when the market opens on Sunday, the chaos begins. We are going to continue this deep dive. We need to look at the bank insolvency angle. Who blew up? Which bank is in trouble? And we need to look at the industrial hoarding that is driving the physical shortage. And we need to map out the path to $100. The system just broke, and silver is the only way out. We need to investigate the casualty. When an asset as large as the silver market moves 10% in a single day, it creates a blast radius. There's a zero-sum game in futures trading. For every winner, there's a loser. The longs made billions today. That means the shorts lost billions today. Who are the shorts? They are not retail traders. Retail traders get wiped out by a 50-cent move. To absorb a $7 move and still be standing requires a balance sheet the size of a nation-state. We are talking about systemically important financial institutions. We're talking about the bullion banks. Rumors are circulating in London and Singapore this weekend that a major clearing member of the exchange has missed a margin call. This is the Lehman moment of the commodities market. When a clearing member fails, the exchange itself has to step in. The exchange has a default fund. But if the losses are big enough, if silver goes to $100, the default fund gets drained. Then, the other members of the exchange have to chip in to cover the loss. This is contagion. If Bank A blows up because of silver, Bank B and Bank C have to pay for it. This makes Bank B and Bank C weaker. They start calling in their own loans. Liquidity dries up across the entire system. This explains why we are seeing jitters in the bond market. The silver short is not an isolated trade. It is a structural beam in the financial skyscraper, and that beam just snapped. So, on Monday morning, we are not just watching the silver price. We are watching the repo market. We are watching the interbank lending rates. We are watching for signs that the banks have stopped trusting each other. If they stop lending to each other because they don't know who is insolvent from the silver spike, the entire credit system freezes. The Federal Reserve would have to intervene. And how do they intervene? They print money, which sends silver higher. It is the ultimate trap. To save the banks from the silver squeeze, they have to print money, which fuels the silver squeeze. They are pouring gasoline on the fire to try and put it out. Now, let's pivot to the industrial reaction. If you are the CEO of Samsung or Tesla, you just watched silver jump 10%. Your cost of goods sold just skyrocketed. But more importantly, you are terrified of availability. In a market that moves this fast, sellers disappear. Refiners stop answering the phone. Mines stop shipping metal. Everyone is waiting to see where the price settles. This creates a supply shock. Industrial buyers operate on contracts. I need 10,000 ounces on the first of the month. But the contracts have force majeure clauses. If the price moves too fast, the supplier can cancel the contract. We believe that right now, suppliers are invoking these clauses. They are telling Tesla, we cannot deliver at the agreed price. The market is broken. This forces Tesla to go into the spot market. They have to bid for physical metal against the investors. This is a war for atoms. A car company needs the silver to build a car. An investor needs the silver to protect their wealth. Who wins? The one willing to pay the most. And right now, the car company has deeper pockets. This industrial panic buying is what turns a 10% day into a 20% day. They are price inelastic. They just need the metal. Let's look at the physical dealer market. With silver at $79.25, the paper price is approaching the physical price. Usually there is a premium. Physical costs more than paper. But when paper spikes this fast, sometimes it overshoots. This creates a chaotic environment where dealers don't know how to price their coins. I checked a major dealer site just now. They have removed the pricing on Silver Eagles. It says, call for price. Why? Because the volatility is so high that their automated software cannot keep up. If they set the price at $90 and silver gaps to $95 in Asia, they lose money, so they switch to manual pricing. This slows down the velocity of sales. It creates a bottleneck. It also signals that inventory is critical. You don't go to call for price if you have warehouses full of metal. You do it when you are down to your last few boxes and you want to make sure you get the maximum value for them. The supply chain is seizing up. From the mine to the mint to the dealer, the gears are grinding to a halt. Now, let's re-examine gold at $4,534. Gold is up 1.2%. Silver is up 10.2%. Silver is outperforming gold by a factor of 10. This is the high beta effect we promised you. When the precious metals bull market enters its manic phase, silver always overtakes gold in performance. It is smaller, it is tighter, it moves faster. We are watching the gold to silver ratio collapse. At the beginning of the week, it was over 60. With silver at 79.25, the ratio is dropping into the 50s. Traders watch this ratio like a hawk. As it drops, it attracts momentum traders who specialize in ratio compression. They sell gold to buy silver. This adds another layer of buying pressure. People are dumping the expensive metal to buy the cheap metal, which pushes the cheap metal up. This feedback loop will continue until the ratio hits historic norms, 30 to 1 or lower. At 30 to 1, silver would be $150. So even after a 10% day, silver is still the value trade. It has 100% upside just to catch up to gold's current valuation. Let's talk about margin debt. Many retail traders are looking at this chart and thinking, I missed it. It's too high. I should short it. Do not short a parabolic move. The market can remain irrational longer than you can remain solvent. Shorting a monetary metal during a currency crisis is suicide. But what about buying? Is it safe to buy at $79? If you're buying physical, yes. You're exchanging paper for real money. If you are buying paper contracts on leverage, no, the volatility next week will be lethal. We could see a limit down day where silver drops $5, followed by a limit up day where it rises $10. If you are on margin, you will get wiped out in the swing. You will be right about the direction, but you will lose your account. Buy cash, buy unleveraged assets, stay safe. We need to discuss the Monday Open, Sunday night in the US, Monday morning in Asia. The Shanghai Gold Exchange will open first. They will see the 10% move in New York. How will they react? Will they sell to take profits? Or will they panic buy because they realize the West is breaking? Given the industrial demand in China, the odds favor panic buying. Chinese traders love momentum. If they see silver running, they will chase it. They will push the Shanghai premium even higher. If Shanghai opens at $85, New York will have to gap up again. This is the gap strategy. We are moving from intraday trading to gap trading. The price moves happen when the market is closed. During the day, it just consolidates. Overnight, it teleports. This is a sign of institutional accumulation. Whales buy at the open and the close. They don't day trade. Let's look at the political response. If silver hits $100 next week, Washington will notice. They will realize that the green energy transition just got 50% more expensive. Solar panels cost more. EVs cost more. Inflation numbers go up. The politicians will blame speculators. They will blame hoarders. They might call for investigations. They might threaten price controls. Or, as we discussed, they might invoke the Defense Production Act to seize supply. Any political noise will just add fuel to the fire. When governments attack a market, it proves the shortage is real. It validates the thesis. Imagine a headline: White House monitors silver market volatility. That headline alone sends silver up $5 because it tells the world that the stockpile is empty. Now, let's zoom out to the macro picture. The 10% move in silver is a signal that the bond market is breaking. Bond yields are likely spiking. The dollar is likely falling against real assets. We are witnessing the Great Rotation. Capital is leaving the paper economy and entering the hard asset economy. This is a secular trend. It lasts for years. It happened in the 1970s. It happened in the 2000s. It is happening again. But this time, the debt levels are higher, and the supply of commodities is lower. The squeeze will be tighter. The spike will be higher. We are entering the vertical phase. In this phase, technical analysis stops working. Resistance levels don't matter. Overbought indicators don't matter. The only thing that matters is flow. Money is flowing in. Metal is flowing out. Until the money stops or the metal appears, the price goes up. Look at the volume bars on the chart. Today's volume was the highest of the year. This is validation. Price went up on massive volume. This means the move is supported by smart money. It wasn't a low volume melt-up like we saw on Boxing Day. This was a high volume brawl. And the buyers won. They chewed through every sell order the banks threw at them. This means the float has been cleared, the overhead supply is gone, the path to $80, $90, $100 is paved with empty vaults. What should you do this weekend? Prepare. Prepare for the media storm. Prepare for the volatility. Prepare your mindset. You are now holding a high-value asset. Do not tell your friends. Do not brag at the bar. Security is paramount. Also, prepare your exit strategy. Not for today, not for tomorrow, but for the future. At what point does the mania become unsustainable? We are not there yet. We are just starting. But you must have a plan. Will you swap for gold at a ratio of 30-1? Will you swap for land? Write it down. Make a contract with yourself. Because when silver hits $200 and everyone is screaming, buy, you will need that contract to keep you sane. The "it's over" headline of this video refers to the suppression. The suppression is over. The price discovery has begun. The banks have lost their grip on the beach ball. It is rocketing to the surface, and it is going to breach the surface with tremendous force. We are witnessing financial history, December 27th, 2025, the day the silver market broke free. We are currently living through the longest weekend in financial history. It is Saturday, December 27th. The price of silver is frozen on the screen at $79.25. The markets are closed. The banks are closed. The vaults are locked. But the panic is not closed. Right now, in boardrooms across London, New York, and Hong Kong, emergency meetings are taking place. Risk officers are looking at the books. They are looking at the 10% gap that just ripped through their balance sheets. And they are realizing that when the market opens on Sunday night, they might not have enough cash to survive. In part 3 of this emergency broadcast, we are going to look at the systemic risk that has just been triggered. We are going to explain why a 10% move in a commodity is not just a trading event, it is a clearinghouse event. We are going to look at the off-market deals being struck by desperate industrial giants who are bypassing the COMEX entirely to secure metal. And we are going to analyze the retail awakening. The public is finally starting to notice. And when the public moves, the supply vanishes, the system is cracking. Now let's look at the fractures. Most people think that when they buy silver futures, they are betting against a bank. Technically, you are betting against the clearinghouse. The clearinghouse is the central counterparty. It guarantees every trade. It makes sure that if the loser can't pay, the winner still gets paid. It is the firewall of the financial system, but the firewall has a limit. It is designed to handle normal volatility. Maybe 1% a day, maybe 2%. It is not designed to handle a 10% vertical spike in a single session. When silver jumps 10%, the margin requirement for the losing side explodes. Now, let's say a small bullion bank was short 10 million ounces at $70. At $79, they are down $90 million. The clearinghouse calls them and says, wire us $90 million immediately. If the bank says we don't have it, the clearinghouse has to liquidate them. They take the bank's remaining assets and sell them to pay the debt. But what if the loss is bigger than the bank's assets? Then the clearinghouse has to dip into its default fund. This is a pool of money put up by all the other banks. If JP Morgan has to pay for the failure of a smaller bank, JP Morgan gets angry. They stop trading. They pull liquidity. They stop trusting the system. This is the freeze. We are hearing rumors, unconfirmed but persistent, that at least 2 mid-tier commodities trading firms are insolvent as of Friday night. They were caught on the wrong side of the squeeze. If the exchange announces a default on Monday, silver won't just go up, it will go no bid, meaning there will be no sellers at any price because nobody trusts the counterparty to pay them. This is the ultimate bullish signal for physical metal. If the paper casino burns down, the chips are worthless. But the silver in your pocket is still silver. This counterparty risk is driving the smart money to take delivery immediately. They want the metal out of the system before the doors close. While the financial system trembles, the industrial system is taking action. We talked about Samsung and Tesla. They saw the 10% jump on Friday. They know what it means. It means the public price is broken. So they are engaging in off-market transactions. This weekend, procurement teams are flying to Mexico. They are flying to Peru. They are meeting with mining executives. They are saying, we will buy your production. We will pay you $85 an ounce, but you must ship it directly to our factory. Do not send it to the COMEX. Do not send it to London. Why would a miner agree? Because $85 is better than $79, and they get a guaranteed buyer. Why would Tesla agree? Because they secure the metal. They don't have to fight for it on the open market. This effectively privatizes the supply. The silver that used to flow into the public warehouses, the silver that backed the ETFs and the futures contracts, is being hijacked. It creates a ghost supply. The official numbers might say production is stable, but the available production is dropping to zero. This is why the COMEX inventory levels are crashing. It isn't just investors stacking coins. It is global industry realizing that the public market is unreliable. They are building their own private supply chains, and once that metal enters the private chain, it never comes back. It gets turned into a solar panel and bolted to a roof for 25 years. Now let's look at the dumb money, the general public. For the last 3 years, the public ignored silver. They bought crypto. They bought AI stocks. They bought houses. Silver was boring. But look at Google Trends this weekend. Searches for how to buy silver have spiked 300% in the last 24 hours. Searches for silver price prediction are vertical. The 10% move woke them up. The average person operates on momentum. They don't buy value. They buy movement. When they see something go up 10% in a day, their brain says, I'm missing out. They log into their brokerage accounts. They drive to the coin shop. They bring a wave of capital that is price insensitive. This retail tsunami has not even hit the market yet. The markets are closed. The retail orders are piling up in the queue. Market buy on open. Market buy on open. Thousands of these orders are stacking up on the server. When the market opens on Sunday night, those orders execute all at once. It creates a gap. The professionals are trying to cover. The retail crowd is trying to enter. The industry is trying to hoard. And there are zero sellers. This is how you get a limit up open. The pressure is too high. The pipe is too small. And we are standing at $79.25. We are 75 cents away from $80. $80 is a psychological trigger. To the human mind, 70-something feels like high 60s, but 80-something feels like almost 100. Breaking $80 changes the narrative. It validates the triple-digit thesis. Once we cross $80, the media narrative shifts from silver rally to silver mania. Headlines will change from silver up 5% to is silver the new Bitcoin? This narrative shift attracts the speculative hot money, the day traders, the algo bots, the leverage junkies. They will pile in. They will add volatility. They will push the price to 85, 90, 95. They will create a bubble on top of the shortage, and that is okay. We want the bubble. Because the bubble allows us, the holders who bought at $20 and $30, to maximize our wealth transfer. But you must understand the difference between the shortage and the mania. The shortage takes us to $100. The mania takes us to $200. We are currently transitioning from the shortage phase to the mania phase. The 10% candle was the signal. The starting gun has been fired. So the system is fragile. The industry is hoarding. The public is waking up. And the price is sitting at the door of $80. What happens on Sunday night? The Asian markets open first. They will see the US close. They will see the 10% gain. Will they sell? Unlikely. China is the biggest buyer. They will likely gap the price higher to secure more metal. In part 4, the conclusion of this emergency broadcast, I'm going to give you the Sunday night battle plan. I am going to tell you exactly what to watch for when the Globex opens. I'm going to explain the limit up rules again, so you don't panic if trading halts. And I'm going to give you the final verdict on how to handle your emotions during a vertical melt-up. The waiting is the hardest part, but the wait is almost over. Stay tuned for part 4. We are preparing for the open. We have reached the final chapter of this emergency broadcast. We have analyzed the liquidation event that drove silver to $79.25. We have exposed the clearinghouse risks and the industrial panic buying. We have looked at the empty vaults and the broken supply chain. Now we are sitting in the eye of the storm. It is Saturday. The markets are silent, but this silence is deceptive. It is the silence of a compressed spring waiting to release its energy. In less than 36 hours, the Asian markets will open. The electronic futures market, Globex, will come alive, and the entire financial world will be watching one ticker: silver. In this final breakdown, part 4, I'm going to give you the Sunday night battle plan. I'm going to explain exactly what to expect when the market reopens. I'm going to walk you through the limit up rules so you don't panic if trading halts. And I'm going to leave you with the final psychological armor you need to survive the most volatile week in the history of the precious metals market. The system is broken. The price discovery has begun. Let's finish this. Let's play a game of strategy. Put yourself in the shoes of a trader in Shanghai or Tokyo. You just watched New York close up 10% on Friday. You know the Americans are desperate for metal. You know the vaults in London are empty. When your market opens on Monday morning, what do? Do you sell? No, you front run the Americans. You buy everything you can before New York wakes up on Monday morning. This creates a gap up. We are very likely to see silver open significantly higher than $79.25. We could see an open at $82 or $85. This gap is dangerous for traders holding cash. If you are waiting to buy, the price is running away from you. You have to chase it, and your chasing adds fuel to the fire. But for the holders, for you, this gap is validation. It confirms that the fair value of silver is completely disconnected from the Friday close. The market is trying to find a price where someone is willing to sell. And at $79, nobody is selling. So the price has to jump to $85 or $90. It has to keep jumping until it finds a seller. Now, we need to talk about the mechanics of the exchange. The CME group has circuit breakers. These are rules designed to stop a market from moving too fast. In silver, there are daily price limits. If silver rises by a certain dollar amount from the previous close, the exchange triggers a limit up halt. Trading stops, the screen freezes, no buy orders are accepted, no sell orders are accepted. The market is locked. If we gap up on Sunday night, we could hit limit up within minutes of the open. What happens then? Psychological panic. If you are a short seller and the market is locked, limit up. You cannot exit. You are trapped in a burning room and the door is locked. You know that when the market reopens, it will gap up again. You are guaranteed to lose more money. This causes short sellers to place market on open buy orders for the next session. They just want out. If you see a trading halted message on Sunday night, do not panic. It does not mean the price is crashing. It means the price is rising so fast that the computer cannot keep up. It is the ultimate bullish signal. Sit tight, wait for the unlock. The volatility after a halt is extreme, but the direction is usually the same, higher. Watch the headlines on Monday morning. For years, the financial media ignored silver. On Monday, they will not be able to ignore it. A 10% move followed by a limit up open is front page news, but be careful of the narrative. They will call it a bubble. They will call it a Reddit raid. They will bring on experts to say that silver is overvalued. They are wrong. They are reading from the old script. They do not understand the Samsung battery. They do not understand the Chinese horde. They do not understand that the military has run out of metal. Do not let the media shake you out. They are the counter signal. When they scream bubble at $80, it means we are going to 100. When they finally capitulate and say silver is the new gold at $200, that is when we worry. Right now, they are still in denial. Denial is bullish. I want to talk to you, the individual investor. You have held through the bear market. You held through the consolidation. Now you are winning. And winning is hard. You are going to look at your account balance and see numbers you never expected. You are going to do the math. If I sell now, I can buy a car. I can pay off the mortgage. The temptation to sell will be the strongest force you have ever felt. But you have to ask yourself one question. What am I selling for? Are you selling for dollars? The same dollars that are losing value every second? The same dollars that the US government is printing to bail out the bond market? If you sell your silver at $80, you are trading a scarce asset for an infinite liability. You're stepping off the lifeboat back onto the sinking ship. Unless you have a specific life-changing need for that cash, hold. We are in a super cycle. These cycles last for years, not days. The move from $20 to $50 was the warm-up. The move from $50 to $100 is the first inning. The move from 100 to 500, that is the main event. Do not sell your ticket before the main event starts. So here's the verdict on this historic weekend. The system broke on Friday. The paper shorts were liquidated. The physical shortage was revealed. We are entering a period of price discovery that will rewrite the history books. The banks have lost control. The price is now being set by the desperate industrial buyer and the sovereign hoarder. $79.25 is not the top. It is the breakout point. It is the moment where the beach ball finally cleared the water. Your strategy for the week ahead is simple. Watch the Sunday Open. Look for the gap. Expect halts. Limit up as possible. Ignore the volatility. $10 swings are the new normal. Protect your stack. Security is paramount. You are witnessing the greatest wealth transfer of our lifetime. From paper to metal, from debt to equity, from the west to the east. And you are standing right in the middle of it, holding the only asset that matters. Enjoy the weekend. Get some rest. Because on Monday, the world changes. Subscribe.